In Investing 101 today, the manic market is throwing investing plans into a tizzy, but it does not have to be that way. We have Juli Niemann, Executive Vice President of Smith Moore, on the line with us today. Julie, the biggest worry right now are fears of a recession.
Well, the markets are obsessed over any sign that we're headed for a recession. And why are they so focused on that? Well, because the last time out, it was not just a recession, it was a depression almost by every single measurement. So that fear is still out there, even though it was 10 years ago that it happened. And again, this has been a very long expansion, so people are concerned that just this market's going to die of old age, if nothing else. But bull markets don't die of old age. There are always triggers that happen to be out there.
Explain to the audience why that is important and sum up what the yield curve inversion means exactly.
Currently, what the market is really obsessed about is what's called the 10-year bond rate. It fell below the interest rate on a 2-year bond rate. Why is that alarming? Well, if you're going to lend money for 10 years, you should get more interest, not less interest than you would with a 2-year note. And the market is basically saying if that happens, it means that a recession is coming and long-term interest rates will dive. And that's what they're focusing on, is we're headed into a recession because the yields keep inverting here. 10 years going below the 2 years.
How accurate of an indicator is this bond market signal?
This has been a good indicator in the past. In fact, 6 out of the last 10 recessions, this Treasury bond indicator rolled over and the market followed 3 months later. But 4 of the 10 times, it took almost another year for it to follow. So the timing is completely all over the place as to when this will happen. Right now, there's no evidence that we have a recession ahead of us.
What evidence are you seeing in the economy?
The economic news in the United States is still very strong. Now, there's no doubt about it. We are slowing down in terms of the rate of growth. It's a declining rate of growth, but we're not headed into negative growth, and that's what would happen with a recession. Not only does it stop growing, but it heads downward, and we have a contraction in the economy. There's no evidence of that happening right now. But what you do have to be aware of is we're going to continue to have this very wild volatility here. It's almost a manic depressive market. There's a recession, no recession, back and forth, which is going to be very dangerous for anybody who's going to need money within the near term now.
Here's the biggest problem. Some Americans are ready to retire or close to retirement. How are you handling those situations?
Those investors who have to take money out of their accounts from time to time, like retirees, your required minimum distribution, you could be whipsawed in this market because you could take it out in November last year, you were fine, the markets were up. In December, you got killed, and it took a long time to bring the market back for you to make it back. So how do you protect yourself against this? Think in terms of dividing your investments into 3 pots, short, medium, and long term. The first pot of money is how much you're going to need within a year. Put that into a very conservative investment, very short-term bond fund. An ultra-short bond fund would be the best place to do it to earn a little interest until the time where you have to take it out. The next pot should be in a 2 to 5 year holding. So you're looking at a longer-term growth. In other words, this is going to be somewhat conservative as well, simply because ultimately we could see a slowdown within the economy. We could see a slowdown, possibly a recession. Long term, though, the market still looks pretty good. The market did come back after the big crash in 2007, 8, and 9, but it took a long time to come back, much longer than it usually does. So the money that you lost in 2008 and 9 did not come back until 2013. That was a very long period of time just to get back to break even. And that's what everybody's concerned about. Reducing the volatility in your portfolio can hedge against that.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.